Welcome to this explainer. Today, we're unpacking the rather complex and honestly fascinating financial narrative surrounding Hawkins Inc. right after their fiscal year 2026 earnings dropped. If you follow the chemicals and water treatment space, you already know Hawkins has been on an absolute tear lately, but as these latest numbers came out, the market response has been a bit of a tug of war. So we're going to look at the hard data today, cutting through all the noise to see exactly what's driving the company forward and what might be secretly holding it back. $1.08 billion. That's Hawkins' record-breaking revenue for FY 2026. For the very first time in the company's long history, they've completely smashed through that billion-dollar ceiling. It's a massive psychological and financial milestone for a business that has been steadily expanding its footprint all across the United States. CEO Patrick H. Hawkins said it best. Fiscal 2026 was another milestone year for our company as we crossed $1 billion in revenue for the first time in our history. And yeah, that's a massive triumph. But as we're going to see, there's actually this really interesting tug-of-war going on just beneath the surface of that historic headline. It's not all just top-line glory. There are some deep mechanical shifts happening in their accounting that every investor needs to understand. So here's our roadmap for the explainer. We'll hit the billion-dollar milestone, look at their water treatment growth engine, dive into the margin squeeze and EPS drag, tackle the valuation debate, and wrap up with dividends and their future outlook. Let's get right into it. Section 1, the billion-dollar milestone. Let's kick things off with the bull case and really examine these top-line numbers that have everybody in the community buzzing right now. We're looking at a company literally firing on all cylinders when it comes to cash generation and sheer sales volume. Total revenue is up 11%, gross profit up 9%. And just look at that operating cash flow. It surged 30% to over $144 million. That right there is the absolute lifeblood of any growing business, giving them the dry powder they need to execute their strategies. Meanwhile, adjusted EBITDA, which is great because it strips out some of the accounting noise to show core operational profitability, is up 6% to hit $179 million. Moving on to Section 2, water treatment growth engine. So how exactly did they pull off this massive top-line growth? Well, the secret sauce was heavily tied to aggressive, highly targeted acquisitions within a very specific sector. Hawkins didn't just sit around waiting for organic growth. They went on an absolute shopping spree. 6 transactions closed during the fiscal year. They grabbed intercoastal trading to expand into the Mid-Atlantic, scooped up Wofford Water Service down in Mississippi, and added Water Surplus along with 3 other tuck-ins. These 6 strategic purchases totaled about $167.1 million in acquisition spending. And the result? It fueled a massive 22% growth in their water treatment segment alone, bringing that specific segment sales to a towering $543.3 million. To really ground these numbers, we have to remember Hawkins is a physical, boots-on-the-ground business. They are providing critical, non-discretionary services. We're talking clean drinking water, treating wastewater, making sure food and pharma products are actually safe. These new acquisitions aren't just numbers on a spreadsheet for them. They represent real, expanded physical infrastructure and a widened customer base that relies on Hawkins every single day. Which brings us to Section 3, margin squeeze and EPS drag. Now we got to pivot to the bear case. We need to peek under the hood to see the hidden costs of all this rapid M&A expansion. Because look, when you buy 6 companies in 12 months, it's going to leave a mark on the balance sheet. Take a look at the stark contrast here. It perfectly illustrates the disconnect that's kind of confusing casual observers right now. Total revenue? Up 11%. Gross profit? Also up. But check out the bottom 2 rows. Net income actually dropped 3% to about $81.5 million. And diluted earnings per share, or EPS, fell from $4.03 down to $3.91. So you're probably asking, how does a company sell over $100 million more product but take home slightly less net profit? Well, the answer is the cost of growth. That margin squeeze and EPS dip were primarily dragged down by roughly $16.5 million in extra expenses tied directly to those 6 acquisitions we just talked about. We're talking higher interest from borrowing money for the deals, increased amortization, and these things called earnout liabilities. Now, an earnout liability is basically a future payment a buyer agrees to make if the purchased business hits certain targets. From an accounting standpoint, Hawkins has to record that potential future payout as a liability today, which literally takes a bite out of their currently reported net income. All right, Section 4, the valuation debate. This brings us straight to the tug-of-war playing out in the market right now. The big question, are investors overpaying for this stock? Here's the crucial point. You are currently paying a massive premium for Hawkins. Trading at a 40.1 trailing price to earnings ratio, it is hovering way, way above the U.S. chemicals industry average, which sits at just 23.9. You are paying a really rich premium for less consistent immediate profitability, all driven by those acquisition costs we just examined. Here we literally see the conflict laid out side by side. On the bull side, analysts are looking at Hawkins' awesome 5-year average EPS growth of almost 14%, and they're slapping a super optimistic $188 price target on it. They're betting Hawkins will easily digest these new businesses and get right back to its historic earnings pace. But then you have the bear side. Skeptics are quick to point out that the net margin just slipped from 8.7% down to 7.5%. Furthermore, if you run strict discounted cash flow models, the stock's fair value sits significantly lower, around $117.22. It's a classic battle between long-term growth believers and strict current value fundamentalists. And finally, Section 5, Dividends and Future Outlook. Let's synthesize all this and see how it builds into the company's long-term stability and shareholder returns. Because honestly, despite the short-term noise, Hawkins has a track record that's just hard to ignore. Despite the recent margin compression and the accounting drag from their buying spree, just look at how Hawkins has generated massive, sustained stock outperformance over the last 5 years. They have absolutely left the NASDAQ Composite, the Russell 2000, and the S&P Small Cap 600 indices in the dust over this period. Management's outlook remains incredibly positive, and it rests on a real bedrock of stability. Get this, they just marked their 41st consecutive year of paying a dividend. 41 years. That is 4 decades of reliable shareholder returns. They even bumped up the FY 2026 dividend by 7% to 75 cents a share. And remember that EPS dip we talked about earlier? Well, management notes that if you look at pro forma EPS, meaning if they had owned these new acquisitions for the entire year instead of just a fraction of it, EPS would have actually increased by 9%. Plus, despite spending $167 million on M&A, their leverage ratio is super manageable at 1.37 times adjusted EBITDA, with plans to pay that debt down aggressively. Which leaves us with the ultimate question to wrap up this explainer. As you weigh all these numbers, ask yourself, does Hawkins' aggressive, highly successful expansion in the non-discretionary water treatment sector justify buying in at a 40x premium? Or do those newly compressed margins and earnout liabilities signal that maybe we need to be a bit cautious until the dust settles? It's a classic standoff between top-line triumphs and bottom-line realities.